These are 7 legal strategies the wealthiest people on Earth rely on to protect their fortunes and pass them down intact. The same strategies that help the 25 richest Americans pay a so-called true tax rate of just 3.4%, while their combined wealth climbed by $401 billion. Every method you are about to hear is completely legal, documented in government filings, leaked records, and investigative reporting, and we are going to walk through all 7 of them. Let me begin with the number that frames everything else. ProPublica's June 2021 investigation, called the Secret IRS Files, found that the 25 wealthiest Americans watched their collective fortune rise by $401 billion between 2014 and 2018. And across those same years, they paid $13.6 billion in federal income taxes. ProPublica said that GAAP represented a true tax rate of 3.4%. Put individual faces on the figure, and it gets sharper, because by ProPublica's calculation, Warren Buffett's true tax rate landed at 0.1%, Jeff Bezos came in under 1%, and Michael Bloomberg paid roughly 1.3%. One fair caveat belongs here before we go deeper. That true tax rate is ProPublica's own measurement. Taxes paid divided by the growth in wealth, which is not how the IRS defines income, and critics reject the idea of treating gains you have not cashed in as income at all. The Biden White House Council of Economic Advisors ran a separate analysis in September 2021 and arrived somewhere similar, estimating that the wealthiest 400 American families paid an average federal individual income tax of 8.2% from 2010 through 2018. The obvious question is how this happens legally, and that is exactly what the next 7 strategies explain. Strategy 1 is trusts, the foundation of elite estate planning, and 3 versions are worth knowing. The first is the Grantor Retained Annuity Trust, known as GRAT. These became possible in 1990, and a court case in the year 2000, Walton versus Commissioner, blessed the most aggressive version of the technique. Here is how it works. You place assets into the trust and take back an annuity for yourself, which means anything those assets earn above an IRS set hurdle rate passes to your heirs, free of gift and estate tax. ProPublica found that more than half of America's 100 richest people have leaned on GRAT trusts and similar trusts to sidestep estate taxes, and the scale is genuinely staggering. From 2010 to 2013, Sheldon Adelson ran 25 of these to move at least $7.9 billion to his heirs, dodging roughly $2.8 billion in gift taxes. Zoom founder Eric Yuan pocketed savings of more than $2 billion using GRAT trusts around Zoom's 2019 public offering. According to the attorney who pioneered the technique, cited by Bloomberg, GRAT trusts may have cost the U.S. Treasury somewhere around $100 billion. The second version carries a strange name, the Intentionally Defective Grantor Trust, or IDGT, and the defective part is no accident. For income tax purposes, the trust is treated as broken, which means the grantor keeps paying the income tax on its earnings, and that lets the assets inside compound without tax erosion, while sitting safely outside the taxable estate. The third version is where things turn generational. The dynasty trust. Washington created a federal generation-skipping transfer tax in 1986, specifically to stop families from handing wealth down forever without taxation. But here is the thing. South Dakota had already scrapped the centuries-old rule against perpetual trusts back in 1983, a full 3 years before that tax existed. The payoff is enormous. The South Dakota Trust Company calculates that $5 million placed in a 120-year dynasty trust, growing at 6% a year, balloons to $5.4 billion, whereas that same gift, handed over directly after taxes, would deliver only about $340 million. That hands us strategy 2, which is choosing the right jurisdiction. Where you park your money turns out to matter just as much as how you structure it, and the surprising capital of this world is not Switzerland at all. It is South Dakota. The Pandora Papers, released by the International Consortium of Investigative Journalists in October 2021, revealed that assets sitting in South Dakota trusts quadrupled in a single decade to $360 billion. By 2023, the Institute for Policy Studies pushed that figure above $500 billion. The appeal comes down to a stack of advantages. No state income tax, no capital gains tax, no inheritance tax, perpetual trusts since 1983, and the strongest privacy protections in the country, because trust filings there can be sealed permanently. The Tax Justice Network's Financial Secrecy Index ranked the United States number 2 in the entire world in 2022. Other states chase that same business, which is why Alaska and Delaware passed the first asset protection trust laws in 1997, with Nevada following in 1999. When domestic options are not enough, Strategy 3 takes you offshore. The best-known destination is the Cook Islands, which enacted the world's first modern asset protection trust law in 1984. What gives it real teeth is the legal design itself. Cook Islands courts refuse to recognize foreign judgments. They require a beyond a reasonable doubt standard for creditor claims in civil cases, which is the criminal standard, and they enforce a tight statute of limitations. Industry sources say no creditor has successfully clawed back assets through Cook Islands courts in more than 30 years of contested litigation. That includes cases brought by the U.S. Federal Trade Commission. Setting one up costs roughly $20,000 to $25,000, with annual maintenance fees on top. The sheer size of this offshore world snapped into focus with the leaks. The Pandora Papers totaled 11.9 million documents and named more than 130 billionaires from 45 countries. They laid bare the offshore dealings of 35 current and former world leaders. And the investigation cited an estimate of at least $11.3 trillion held offshore around the globe. Years earlier, the Panama Papers in April 2016 exposed 11.5 million documents from a firm called Mossack Fonseca. The fallout toppled Iceland's prime minister, and by 2019 it drove more than $1.2 billion in recovered back taxes and fines worldwide. Strategy 4 shifts the game from hiding wealth to shrinking it on paper, and that's the family limited partnership. The idea is clever. Parents drop assets into a partnership, whether that is real estate, securities, or a business, keep control for themselves as the general partner, and then gift limited partnership interests to their children. Because those limited interests cannot easily be sold or controlled by the children, the IRS permits their value to be discounted for tax purposes, usually somewhere between 10 and 45%. The math is the whole point. $2 million worth of assets might be valued at just $1.4 million for tax purposes, which quietly shrinks the taxable gift. None of this is unlimited, though. In a case called Estate of Fields versus Commissioner, the tax court threw out those discounts after a partnership got funded less than a month before death, while the person kept access to nearly all the income. The structure has to be real. Strategy 5 is the one that looks the most charitable on the surface, and it covers foundations and donor-advised funds. Private foundations carry a requirement to pay out only 5% of their assets to charity each year. By the middle of 2024, U.S. foundation assets had reached nearly $1.6 trillion. Yet according to the Institute for Policy Studies, only about 6.67% actually gets disbursed annually. Then come donor-advised funds, or DAFS, and the benefits stack up fast. You collect an immediate tax deduction the moment you contribute, up to 60% of your income for cash. You dodge capital gains tax on any appreciated assets you hand over. The The money grows tax-free inside the fund, and here is the part that matters most: there is no mandatory payout requirement whatsoever. The donor-advised fund research collaborative counted 3.56 million DAFs, holding $326 billion in 2024. The loophole reporting keeps highlighting is this: a private foundation can satisfy its 5% payout simply by shoveling money into a DAF, which then carries no obligation to give any of it away. Elon Musk's foundation reportedly met its 5% requirement only through transfers like these. That charitable angle carries us into strategy 6, which is arguably the beating heart of the whole system: buy, borrow, die. USC law professor Edward McCaffrey coined the term, and the logic runs in 3 moves. First, you buy assets that appreciate over time. Second, rather than selling them and triggering taxes, you borrow against them, because loan proceeds simply aren't taxable income, and securities-based loans often reach 70 to 90% of the value of what you hold. The SEC filings make this concrete. In 2023, Larry Ellison pledged Oracle shares worth around $45 billion as collateral, and as of May 2021, Elon Musk had pledged Tesla shares worth roughly $57.7 billion. Then arrives the third move: die, and this is where the whole thing locks into place. Under a provision called stepped-up basis, when you pass assets to your heirs, the cost basis resets to the market value on the date of death, which means all the appreciation built up across your entire lifetime, every dollar you borrowed against but never sold, simply evaporates for tax purposes. The stakes are hard to overstate, because billionaires and centimillionaires held at least $8.5 trillion in unrealized capital gains in 2022, much of which could escape income tax permanently through this exact path. Strategy 7 brings us to life insurance, though not the kind sitting in most people's filing cabinets. This one is called Private Placement Life Insurance, or PPLI. A 2024 Senate Finance Committee investigation, led by Senator Ron Wyden, found the industry holding at least $40 billion across roughly 3,000 policies, with an average face value of about $13 million apiece. The report's title described it without much subtlety as a tax shelter for the ultra-wealthy masquerading as insurance. It functions as an insurance wrapper placed around investments like hedge funds, which delivers tax-free growth, tax-free loans, and a tax-free death benefit. Wyden put it plainly, and I'll quote him directly: "I'm a strong defender of life insurance as a source of financial security for hard-working American families and retirees, but that's not what's going on with these tax-dodging, private placement policies that are available only to the ultra-wealthy." The natural question now is where all of this stands today and what any of it means for you. The entire system rests on a single number. On July 4, 2025, the One Big Beautiful Bill Act locked the federal estate and gift tax exemption permanently at $15 million per person, or $30 million per couple, starting January 1, 2026, and anything above that line faces an estate tax fee of 40%. That permanence is the anchor every one of these strategies is bolted to. Though permanent in tax law really only means permanent until Congress decides otherwise. A real fight is underway over whether it should change. Critics, including Senator Wyden, Senator Bernie Sanders, and Senator Elizabeth Warren, have floated wealth taxes and taxes on unrealized gains. Economists Gabriel Zucman and Emmanuel Saez have pressed for a global minimum wealth tax. After ProPublica's expose landed, Senator Warren wrote that our tax system is rigged for billionaires. Defenders push back hard. That group includes the National Taxpayers Union and the Tax Foundation, who argue that taxing unrealized gains raises constitutional problems and could choke off entrepreneurship. The Supreme Court brushed against the edge of this question in June 2024 in Moore v. United States, yet it deliberately left the central issue unresolved. Meanwhile, the IRS, working with recent funding, announced that it had recovered more than $1.3 billion from high-income individuals by July 2024. Here's the honest takeaway, and it loops right back to where we started. The reason the richest Americans can pay a true tax rate of 3.4% has nothing to do with fraud and everything to do with architecture, trusts, jurisdictions, partnerships, foundations, borrowing instead of selling, and that reset at death all stacked together into a legal machine most people never get to see. The harder truth is that nearly all of these tools, the $15 million exemption, the dynasty trusts, the offshore structures, and the private placement insurance, were built for fortunes most of us will never hold. The underlying principles, though, aren't entirely out of reach, because you can hold appreciating assets. Instead of constantly selling them, you can recognize that where and how you hold wealth changes what you actually keep, and you can use the tax-advantaged structures that are genuinely available to you. The billionaires never invented secret loopholes. They simply learned the rules better than everyone else, and then built their entire lives around them.